Welcome to Market Domination. I'm Julie Hyman. Look who's back. Josh Lipton is back. Live from our New York City headquarters, we're giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
Making President Trump happy is always a good strategic move for a CEO of a company who's very much exposed to the types of policies that are going to come from this administration. I would focus less on the bombastic number. Again, this is a number that's made to make a political statement, but more on the fact that some of these investments may actually be incremental.
What has Nvidia done the past 2 years, David, that would suggest they're not going to come out here and beat big this week and raise up their estimates for the first quarter?
They've done nothing the last couple of years other than the foolishness. Well,
then why does everybody on the street own the stock?
The foolishness of an investment thesis that suggests that what has happened the last couple of years always repeats itself.
So we don't need AI chips from Nvidia.
Have learned the lesson against that the hard way.
So realistically, Intel is more of a value than Nvidia.
No, Intel is not. It's simply a story about valuation of a multiple. It's a story about order flow combined with valuation. There's two dynamics to what places a stock. It's both the fundamentals of the business combined with what you're paying for that story.
I would strongly advise against, over extrapolating these channel checks. Not to take anything away from this analyst, and I'm sure that the things he's hearing are what he's hearing, but I think these are the types of checks that can be very, confusing to take out of context.
We got 1 hour to go until the market close. Putting things in context for you, we're taking a look at the major averages, which are not doing a heck of a lot today. We've seen this trading in a pretty narrow range, but the Dow is performing better. It's up 164 points, about 0.4%. The S&P, very little change to the downside, down about 0.1%, but it's been sort of bouncing around today. The Nasdaq leading the losses, down 0.2%.
Now, we're muted today, but you got a potentially really key critical week here, right? I mean, we do have Nvidia earnings on deck, and yes, Nvidia has not done a whole lot of anything so far in 2025, but we know it is absolutely foundational to the AI trade and trend, AI economy. We got key inflation data on deck as well, so you're gearing up here for what could be a really important week.
Right, and coming off of a period of weakness for big cap tech in particular. I mean, last week, as we know, we had big selling to end the week. I don't know if you were watching from where you were away, watching the charts, but with the Nasdaq in particular having a weak period here. So falling again today, not seeing a bounce back, sort of an automatic bounce back from that loss is interesting to see. Now, as for Nvidia, as you say, let's take a quick look at how it is done this year. Well, today it's down about 2%. If you look at the year-to-date chart here, this here was actually a record high for Nvidia back on something like January 6th, I believe. It has not retaken that. It has made an attempt here, made a little bit of a weaker attempt there, but it's making what chartists like our own Jared Blucher would call lower highs, right? It is not retaking that. And so this is the setup that we are faced with going into the earnings. But guess what? Other large cap tech isn't doing a heck of a lot either. We were just hearing from an analyst talking about the report that Microsoft was perhaps pulling back on some of its AI infrastructure spending. The company says in a statement it's sort of maybe moving some things around, but not necessarily pulling back. But Meta shares down 2%, Amazon down 1%, Tesla down 1%.
Yeah, on Nvidia, by the way, we do have a very smart analyst who's going to come on the show, walk us through what to expect with that earnings print. I would point out to Apple, though, bucking that trend a bit in big tech, up about 1% today's trade. Of course, Apple made a lot of headlines today. Tim Cook's company saying, listen, we're going to spend and invest more than $500 billion in the U.S. for the next 4 years. We're going to hire 20,000 workers. We're going to produce AI servers here. And it kind of brings up just, I think, bigger questions, not just about the relationship between the Trump administration and Tim Cook's company, but just really overall this relationship between Trump and big tech.
Yes, most definitely, which we're also going to talk about later in the show. Quickly want to look at the sectors today. We've got tech doing the worst. We've got healthcare doing the best. But if you look at the year to date for the sectors here, we really have seen a shift here. Consumer discretionary, the worst. Tech only up 0.2%. 2%. So again, just emphasizing the Mag 7 is not leading the gains anymore. Communication services is up because of Meta, and then healthcare is the best performing group, with RFK set to become HHS secretary. That's not necessarily what one would have expected year to date.
For sure. Well, let's get more on this now, because stocks are under pressure ahead of the closing bell as the markets brace for Nvidia earnings on Wednesday. And joining us now is Simeon Hyman, global investment strategist at ProShares. Simeon, it is always good to see you. Maybe just off what Julie was just talking about there, Simeon, something interesting you said, which is that investors seem to be now perhaps questioning whether there was a change in market leadership taking place here. What do you mean by that, Simeon?
Look, the good news is that tech stocks aren't falling through the floor. They're not leading, but they're not falling through the floor. So we're not in a position of suggesting that this is back to where we were in 1999. There's good stuff here. There's tremendous cash flow generation, and the S&P 500, driven by that cash flow generation, has very low levels of debt. But things are changing at the top of the house, as you noted. Tech is almost at the bottom of the house in terms of performance so far year to date.
So how do we know if this is, sort of, sometimes we get this at the beginning of the year, right? You get sort of the scramble, scrambling up of the best performers from last year that then fall behind. How do we know if this is a sustained change in leadership? Do we just have to wait to find out, or what do you think?
I think you have to combine what the market's telling you with the fundamentals. And it's why, and look, it's tough to be the broken clock right twice a day. We always talk about dividends at ProShares, but dividend, and particularly growth and dividend growth, is on sale. And it's on sale in a way that it hasn't been in a long time. But even though the price has lagged, the fundamentals haven't. The S&P 500 Dividend Aristocrats, it's our ETF ticker, NOBL. You've got double the dividend yield. The dividends grow faster than the S&P 500, but the return on capital is 50% greater than the S&P 500. So I think you don't just want to shop in the bargain bin, you want to shop for quality on sale. And that's where you can get some sustained new leadership over the course of the next few quarters.
I have a separate question, Simeon, just as a long-time market watcher. I'm just curious to get your thoughts. When you hear that Warren Buffett, greatest value investor of all time, and you heard, Simeon, the kind of cash pile he's now sitting on, it's basically the market cap of Coca-Cola. When you hear the Oracle would rather sit on that than put that to work, what, as a long-time market watcher, what is that telling you as an investor?
It is tough to pay over 30 times for the companies that are having some of the greatest earnings growth. Q4 earnings were still very, very strong for technology, but it's tough to put that at work at 30 times. But there are opportunities. As an example, IBM is a S&P 500 Dividend Aristocrat. It's up 20% year to date, on the back of saying their AI business is good. So there may not be nothing wrong with the fundamental thesis. It just may be that those Mag 7 stocks got a little bit too expensive. And look, those of us who aren't great market timers, you can't sit on cash forever. We all know the numbers. You miss a couple of the biggest days and you're out forever. And by the way, if you're looking to manage risk, we would suggest don't stay out of stocks. Just make sure you have your balanced portfolio again, because we don't have zero yields on the 10-year Treasury. Look what's happening right now. The 10-year has rallied. So the ability for bonds to diversify stocks are back, and that's the prudent way for most people to manage risk, not staying in a money market fund.
Well, and you are the latest in a parade of folks lately who has said you need to be more diversified right now than you have been. It's not good enough to just buy the Mag 7 and forget it at this point. So what does that diversification look like? Do you buy, say, the S&P equal weight? Do you go down in size? Because small caps have not been doing much for you if that's the way that you have gone.
You can't stop at just adjusting your large cap portfolio in an equal weight sense. If you go back to the early aughts after the tech bubble burst, equal weight helped you, but you know what helped the most? Mid caps. Why use a blunt instrument of just equal weighting the S&P 500 when you can just have mid caps?
And everybody kind of forgets about mid caps.
It's the highest performing segment of equities over the last several decades. They're 50 cents on the dollar to large. And if you want a little extra, opportunity there. The dividend growers and mid-caps are on sale even cheaper than the S&P 400 themselves. The S&P 400 Dividend Aristocrats, RETF ticker REGL. It's a very cool way to get mid-cap exposure.
Simeon, do you want to stay U.S. focused, or do you see any opportunities overseas? I guess it was today, for example, Chinese names. Some of them are really getting batted around, but some of those names have enjoyed nice recent runs, Simeon.
On the domestic front, there is an opportunity, particularly in mid-caps, to be a little bit sheltered from the tariff story. So mid-caps as a whole have 75% of their revenue sourced domestically, as opposed to about 50-50 in the S&P 500. And that makes a lot of sense to us, have a little bit of defense there. But I'm an investment policy statement guy. That means you don't zero out big parts of the market, and particularly developed international markets are still 20-25% of the equity land. So even if you want to be patient there, you still got to have 10 or 15% in your portfolio.
Simeon, good to see you. Thanks for coming in.
Thanks for having me.
We're just getting started here on Market Domination. Coming up, Nvidia earnings are indeed in focus this week. We're going to speak to an analyst on the other side to break down what to expect from the chip giant. Plus, Apple is betting big on the future of America, and President Trump, predictably, is loving it. We'll discuss the relationship between big tech and the United States government later in the hour. Stick around, much more Market Domination still to come.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor.
Podcast that will make you a smarter investor.
Welcome to Stocks in Translation. I'm your host, Jared Blickery. Welcome to Financial Freestyle.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Welcome to Trader Talk, the podcast that dishes out the market straight up.
Welcome to Capital Gains. I'm your host, Madison Mills.
Welcome to Word Money. I'm Patrick Murphy.
And I'm Dan Coons.
From Wall Street to Main Street to the C-Suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Nvidia is set to report fourth quarter earnings on Wednesday after the bell, and while the street expects it to deliver a solid beat on revenue and earnings, investors will be paying close attention when it comes to topics like supply and demand, forward guidance, the possibility of new tariffs, and the impact of China's DeepSeek. Joining us now, John Vinh, KeyBank Capital Markets equity research analyst. John, a longtime Nvidia bull, I think it's safe to describe you as someone who has been reading your notes for a few years now on Nvidia. Let's take the DeepSeek part of this first. Let's just dive right into that, because you talk about that the demand for DeepSeek will cause demand for different types of chips from Nvidia. Why do you think, though, it won't hurt its main business?
So I think over the long term, I think the compute TAM, or the compute processing that's needed to train these, AI models, versus where we thought it was maybe a few months ago, that potentially TAM is going to be a little bit smaller, right? These optimizations that DeepSeek had introduced are likely going to be incorporated into some of these other AI models that Google and OpenAI are also developing. That for sure is likely going to happen. In the near term, DeepSeek is driving a surge in demand for these NVIDIA GPUs, these H20s that are China compliant by Chinese hyperscalers, because I think these hyperscalers recognize that it's possible for them to be able to train a lot of these AI models with lesser processing capabilities.
John, you just mentioned those hyperscalers. We just heard from them reporting their earnings results. Did you hear anything, John, from those big cloud giants that made you think they're spending as they build out AI infrastructure, as they spend on Jensen Huang's chips? Did you hear anything that signals or suggests, John, that spending is going to slow down in the near to intermediate term?
I don't see that happening anytime soon. The CapEx numbers have been really strong from all the major hyperscalers. I don't think anyone's kind of budging from, the CapEx intensity plans there. I think if you listen to kind of Sam Altman talk about it, he said, DeepSeek R1 is a very good model, but he kind of talked about it and saying, well, that addresses kind of a niche, maybe lower end segment of the market that's probably going to be used more widely within the China domestic market. But when you think about just globally, OpenAI and Google and Meta are going to develop AI models that are going to be much more comprehensive, addresses kind of high performance models, and they're going to require a significant amount of compute capabilities. So I don't see a let up at this point in time.
So John, when it comes to what we're going to hear from NVIDIA, both the numbers and the forecast, where do you think the suspense lies? Is it going to be more about whether they are able to make as many chips as the market would like?
I think, like every earnings, right? The call is going to focus on the results and the guidance. I think the results are going to be very strong. NVIDIA has this cadence of just moderately guiding above consensus, and they're typically very conservative about that. But I think the focus on the call is really going to be around Jensen's commentary about DeepSeek, right? And I think he's going to come out and he's going to embrace DeepSeek, right? And he's going to say, DeepSeek is great for AI. It's expansive to the overall TAM, and it's not going to be, it's not going to kind of cut down on the opportunity that's ahead of us. And if you think about it, Jensen met with President Trump at the end of January. Coming out of that meeting, there was not a ban on China AI chip exports, as most people had feared. So it seems like, at least in the near to medium term, he's got the current administration on board with that sort of view.
John, I'm curious, what do your checks indicate right now about what supply and demand look like for Blackwell, their new chips?
I think supply is in a good position. I do think that there are some bottlenecks related to the ramp of NVIDIA's next generation Blackwell GB200 NVL platforms. These are the full server stack solutions that sell for $3.5 to $4 million. I think that's going through kind of a ramp up curve. There's some yield issues with that. But what we're hearing is that customers are able to pivot. And if they're not able to get these GB200 NVL server racks, they're able to pivot and order some of these more traditional server AI systems for Blackwell that are based on kind of the B200 chips. And then I think lastly, I do think that some of that yield and supply constraints is going to be backfilled by the strong demand and surge that we're seeing right now for these China-compliant H20 chips as well.
John, what do you think the biggest risk is to NVIDIA right now?
I think the biggest risk to NVIDIA over the kind of the medium to longer term is whether how quickly these optimizations that DeepSeek has introduced make their ways into these kind of frontier AI models that are being developed by Meta, OpenAI, and Google, right? So if those optimizations get incorporated to these models, and that results in a significant reduction in the amount of compute intensity required to train these models, that could represent a source of risk to NVIDIA over the medium term.
Finally, we did want to ask you about Apple's new investment in, U.S. jobs and U.S. manufacturing, and just sort of the implications of this move and some of the other moves that we've been seeing to bring some of these operations to the U.S. As part of this, Apple's going to buy some more chips. It's already been planning to. Going to buy more chips from the TSMC plant in the United States. How are you thinking about the implications of all of this for the chip industry in the U.S.?
I think it's great. I think there's a few things that are driving that, right? Apple seems like they're behind on the Apple Intelligence race. We also kind of do a lot of surveys on a monthly basis on iPhone demand. And right now, from our surveys, Apple Intelligence is the complete non-factor in terms of driving demand for iPhones. And that's pretty disappointing, right? Because we've been bullish around the long-term opportunity around edge AI, but I don't see that driving any sort of demand right now. And I think Apple recognizes this. So they are obviously being forced and aggressively investing into their AI infrastructure, right? And I think the goal of that investment is to drive a differentiated AI strategy for them to develop compelling AI applications in these iPhones going forward, and to drive traction in Apple Intelligence.
John, always great to see you and to have you on the show. Thank you, sir.
Great, thank you.
Apple announcing it's investing $500 billion in the U.S. over the next 4 years, much to the delight of President Trump, who thanked the company and CEO Tim Cook this morning on Truth Social. The announcement coming as big tech continues navigating through Trump's ongoing trade wars. And for more, we're bringing in now Nikki Kristof and company CEO. Nikki, it is good to see you. So Apple certainly making big news today, Nikki, $500 billion here in the U.S. over the next 4 years, 20,000 workers producing AI servers here. One question I would have, Nikki, as an Apple investor, I guess I'd want to know, did Tim Cook and company, did they do enough here to kind of satisfy Trump, make the president happy enough so that if there is need for it, Nikki, Trump could now say, you know what, Apple, you've done enough. You have earned that special tariff carve-out, that tariff exemption. As remember, of course, Apple did back in 2018. What do you think, Nikki?
Well, that's exactly right. They did get an exemption from Chinese tariffs during the first Trump administration. Whether or not they did enough, I'm going to say probably not. What they did deliver, what Tim Cook delivered for Donald Trump, was a great headline, $500 billion in investment in the United States, 20,000 jobs. That's not nothing. But not only do we have to think about the Chinese tariffs, which he's promised, but also India tariffs. There are an awful lot of iPhones made in India, and we still don't know yet what those are going to look like. So I would be very surprised if this gets them to get out of jail free cards.
So what do you think would rise to that level, right? We've had a handful of these announcements thus far about investments in the U.S. Some of them are sort of repackaged of existing stuff that the companies are planning on doing. Some of it, you got a little new investment mixed in. What do you think would earn the carve out from Apple or from other companies who are trying to get it?
Okay, well, if I knew that, I might be on Apple's board, but I do have an idea of something that they could do. I think that what Donald Trump likes is to deliver on campaign promises. And he has promised to bring manufacturing jobs back to the US. He's been promising that for a decade. We have not seen a lot of success on that. They are talking about working with their existing suppliers in a lot of red states, including Arizona, Michigan, Texas, to start manufacturing there. If they can actually put people into manufacturing jobs, I think that is going to go a long way with the president. The second thing is if they can shift from nearshoring, there was a lot of talk about building things potentially in Mexico, and make it clear that they've changed from even considering that to moving fully to the United States. I think those are two more things they can do to get goodwill with the president.
I wonder, Nikki, if Trump, he's hanging out there in Mar-a-Lago with another CEO, and he could say now, listen, Tim Cook, he just announced $500 billion he's going to spend and invest here in the U.S. over the next 4 years. I wonder, do you think it could be used by Trump as kind of leverage when he's talking to other execs?
Absolutely. This administration loves to line everybody up and make them agree to different things. We just saw Microsoft, as an investor in OpenAI and part of the Stargate Alliance, agree to a similarly sized investment in the United States. There's only so many companies that can go that far. But, Tim Cook and Apple are at the very front edge of this, of making commitments and giving good headlines. And the president wants to move fast on the things that he has promised. And that is America first, including having American companies make things here. So I am certain that that is a point of leverage with other conversations.
Nikki, this Trump term feels very different from the last Trump term in a number of different ways. And one of them is that companies seem more willing to work with the president. Is that defensive? Is that offensive? What do you think is driving it? And what, are we seeing a disconnect? I mean, you talk to these companies. Are we seeing any kind of disconnect between these public-facing announcements and what they're saying behind closed doors?
This is a great question, and I don't think that you can lump all of the CEOs and the companies and executives together. You have people who appear to be more ideologically aligned with where President Trump and this administration is. I'd cite Mark Zuckerberg of Meta. And then you have people who are pure businessmen, right? Like the Jeff Bezoses of the world, who really doesn't need very much from this administration. And so you have a spectrum where I'm not sure their ideology matches with their business imperatives, but all of them have businesses to run. I think the difference, to your point, is that in the first administration, things were extremely chaotic. They moved much more herky-jerky throughout these first 100 days. That is not the case. They are moving at pace. They have an overwhelming majority in both Congress and in the election results. And so there appears to be a mandate. The president is moving fast, and they are jumping as required. And that is part of their jobs. How they feel ideologically, I'd say it's, people have described Tim Cook as 10% political and 90% business person, and I think that's right.
Do you think, Nikki, Trump, he may talk tough, but do you think he would ever actually do anything to really go after big American tech, to jeopardize American tech in any meaningful way? Because if he did that, Nikki, he of course knows he might, jeopardize the stock market. And this president watches the market very carefully. He uses the stock market as a kind of report card on the administration's success or failure.
Well, one definite boon to the technology industry with this administration is you have already the vice president going overseas to Europe and saying, you guys have been a drag on our companies. The prior administration was brutal when it came to competition with big tech. I think we still might see some of that, but at the end of the day, President Trump sees himself as a business person, and he loves business success. So no, I don't think he's actually going to kneecap American tech companies, but he does want them to show up and show some deference and give him some good headlines, which, again, Apple has done this week.
It sure did. Nikki, great to see you as always. Thanks for joining us.
Nice to see you. Thank you.
Nvidia in focus ahead of the company's earnings later this week. Analysts expect double-digit growth for both adjusted earnings per share and revenue. Investors are waiting to hear from CEO Jensen Huang and what he says about the environment for AI chip demand and potential rising competition in the space from China's DeepSeek. Yahoo Finance hit the streets of New York to ask everyday investors about how they're deploying their cash and whether or not Nvidia is part of their portfolio.
I hold about 25 different stocks.
Currently, I like to invest in a lot of AI.
AI is the future.
With the rising AI.
I don't own Nvidia. I just haven't invested in specifically because I felt like I missed out on the wave.
No, I'm not invested in Nvidia. I haven't really followed the hype train too much on it.
To be honest, I don't keep too much track of Nvidia at this point.
I only owned Nvidia shares as part of like an ETF or a mutual fund. If it were 10 years ago and the price were a lot lower, I would have bought a lot of individual shares of Nvidia.
If I had the money, I would definitely invest in Nvidia.
I have some Nvidia, but I sold most of it. I thought that my money could be like better spent somewhere else. If I had more money, I would buy more Nvidia.
I like Nvidia a lot. It did become one of my top stocks. I bought into it a long time ago, around COVID, and then I just got super lucky. I wouldn't buy any more Nvidia, so the price is a little too high for me.
I bought shares last year when they were, well, maybe not the best time because they were really high. I do follow the earnings reports of Nvidia. I think it's definitely going to be positive.
Now time for some of today's trending tickers. First up, we got Palantir. That stock tumbling again Monday, extending its 4-day drop amid investor concerns surrounding potential Pentagon budget cuts and their impact on the data software company's revenue. The shares down more than 25% since last Wednesday. It first fell on reporting that Defense Secretary Pete Hegseth sent a memo to the Pentagon and military leaders looking to slash 8% from the defense budget every year over the next 5 years. Now, you and I have been watching this stock. Is it really down because of this, or is it down because it had run so far?
Yeah, it's a great
and
question.
And people love to complain about the valuation of this company,
right.
which is high.
It's a headline, and you can tease out why some would get sort of nervous about it because, of course, Alex Karp's company does generate significant revenue from the U.S. government. To your point, though, Julie, and you read off the numbers, I mean, it's still up, even now, about 300% roughly over the past 12 months. So if you were an investor and you were looking for a reason to book some profit here, this would be one.
This might be your reason, most definitely. But it is trading at
Look at that
more
chart.
than 170 times estimated
Remarkable.
earnings.
Yeah.
Is that even a real number? I don't know.
Right. Our next trending ticker, let's look at Alibaba. Now, those shares are sliding. That's after President Trump directed the Committee on Foreign Investment in the U.S. to limit Chinese spending on technology and other strategic U.S. sectors. So this one in the red. By the way, it's not just Baba. I mean, I was looking at other Chinese names in the red, too. We should mention these names have enjoyed very nice runs recently. I mean,
not
Alibaba.
Not Palantir-sized.
No, not Palantir.
But healthy.
Was it Palantir-esque? Someone said that recently.
Somebody did say Palantir.
I mean, Alibaba's, I'm looking here. It's up about 50% this year already. K-Web has had a nice jump, almost 20% so far in 2025. But that's the headline. That's why it's under some pressure today.
Yeah, and by the way, just separately, it's talking about spending on infrastructure.
$53 billion.
$53 billion. That's its plan. So it's kind of matching some of the U.S. hyperscaler commentary that we've gotten in spending plans. It's doing it, of course, in China.
All right, while earnings moving along, season is winding down to an end, and the focus we know has shifted almost entirely to Nvidia's results. There are still a few other companies reporting this week that investors should be on the watch for. Let's bring in now the one and only Kenny Polcari, Slatestone Wealth Chief Market Strategist and host, of course, of the Yahoo Finance podcast, Trader Talk. Kenny, always good to see you.
It's always a pleasure to be here.
So we mentioned there, obviously, yes, intention on Nvidia, big earnings print, but there are other names, right? Well-known names. What is Kenny Polcari's radar? What are you looking for?
So based on what we saw towards the end of last week with Walmart and the concern that created, they were cautious on their forecast. It created all kinds of nervousness in the market. Then you had Domino's Pizza today, which grew but didn't hit the estimates. But it wasn't negative, but it just didn't hit the estimates. And so originally they took out this morning, they were taking out 4.5% out of that stock just because I think it speaks to the consumer and the nervousness in the market. So then you got Home Depot and Lowe's that are coming out this week. Now that's going to speak to the consumer and housing and renovations and what are consumers doing. If they're not buying, are they renovating and that kind of thing. So that's going to speak to the health of the consumer. Clearly then there's the Nvidia, which is kind of a crowded trade, so everybody's focused on it. But I don't think Nvidia is going to be. I think Nvidia is going to be fine. I don't think they're going to be disappointing at all.
Well, I guess we'll see.
So let me ask you, Katie, if let's say Nvidia's fine, and you get a benign inflation print, the market reacts how?
So I think then the market rallies, right? If Nvidia's fine. Now, here's the problem with Nvidia. They're going to come out with a good number, and someone's going to find something that they didn't like, and they missed by a tiny bit, and they'll find a reason to take money out of it.
Their last two reports, they have not reacted great.
Correct. And so they could potentially do that again. Even if Jensen Huang comes out and wows them,
right?
They could still, you get the trader types that would hit the sell button because they'll just try to lock in some short-term profits. But look what happened. Right after it doesn't act great, they sell it off, but then they take it right up to new highs, right?
Right.
So while, look, I own Nvidia, we own Nvidia. I'm not selling the Nvidia no matter what happens. I don't suspect he's coming out with a disaster report. I do, though, suspect that he's going to have to address or somehow address the DeepSeek thing, right? However they're going to address it. But after that, I think Nvidia is fine, and I wouldn't. On a pullback, I would look to buy.
More broadly on the SPX, what levels am I watching here?
So I think you have to watch 5,800 on the S&P because look, we had the sell-off on Friday. This morning they tried to rally them, then they turned sour midday. Now they're trying again to kind of bring them back, but it just feels like we were kissing 6150, which was the high. We did it, 3, 4, 5 times, and we couldn't break through, which suggested to me just that the market felt a little bit tired, exhausted, and it needs to consolidate and pull back. So we broke through 6,000, 5,800 would be the level. 6,000 is the short-term trend line, but I suspect that's not going to really hold, and I wouldn't be surprised to see the market trade back to 5,800, which, by the way, I'm kind of hoping it does, because that's going to shake the branches a little bit, and as a long-term investor, it's going to create great opportunity.
All right, we'll see. Thanks, Kenny. Good
Always
to see you.
Always a pleasure.
Be sure to scan the QR code below. You can check out the Yahoo Finance podcast, Trader Talk. It's every Wednesday at noon Eastern. Kenny Polcari brings you expert advice, key market insights from the New York Stock Exchange. Here's a look at the latest episode.
I think you want to go where earnings growth is accelerating, okay?
Right.
So last year, earnings were the name of the game for the Mag 7, okay? Right. They had 33% earnings growth, which was double the market. They should get double the multiple. This year, earnings growth is decelerating from 33% last year for the Mag 7 down to 21%. The multiple has not contracted in line with that decelerating in earnings growth. The rest of the market had negative earnings growth the last first 3 quarters of last year. It's now accelerating, and the multiple is half of the Mag 7.
So let's talk about that for a minute. So if the multiples in the Mag 7, it's decelerating, decelerating, if earnings are decelerating,
earnings growth is decelerating.
Now but that's what your analysis tells you. That's just what is that what all the analysis
bottom-up consensus estimates. Yeah. So earnings growth is going to decelerate from 33% to 21%, and we're seeing it. It's a function of CapEx.
Right.
And people say that this is offense. It's defensive.
Right.
It's defensive CapEx because you have no return on invested capital yet. That's the key.
So
for the next 2 years, they're going to spend a lot of money, and we're going to find out in 3 to 5 years if they're going to get a return on that.
Right, but they've made it very clear. Look at the last earnings season. They've all made it very clear that they're spending huge amounts of money building out AI and data centers and all that stuff, which I think is going to end up coming back. But it might take 3 to 5 years before they really realize the return on that investment.
Yeah, this was the first quarter since 2022 that you had 0% revenue surprises in the Mag 7.
Right.
So we all know what happened in 2022 with tech. It was a little bit softer than people expected.
Right.
Everyone was euphoric going into it. We also have the highest percentage of S&P components trading over 10 times sales since 2000. So there are a lot of multiples and a lot of metrics that point back to 2000. I don't think we're going to have anything like that at all.
Yeah, I don't.
But I do think we're going to have a relative slowdown in terms of, those groups are going to have to consolidate their gains.
And that's actually okay.
It's very healthy.
To do that.
Very healthy.
You can't keep, trees don't go to the sky, right?
100%.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs?
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor.
Podcast that will make you a smarter investor.
Welcome to Stocks in Translation. I'm your host, Jared Blickery. Welcome to Financial Freestyle.
Hi, I'm Bob Howell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Welcome to Trader Talk, the podcast that dishes out the market straight up.
Welcome to Capital Gains. I'm your host, Madison Mills.
Welcome to Word Money. I'm Patrick Murphy.
And I'm Dan Coons.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Tesla shares getting a vote of confidence from one of the stock's biggest bulls despite concerns over CEO Elon Musk's involvement in the Trump administration. Praz Subramanian is here with the details. Praz.
Yeah, Josh. Dan Eiswhite called the godfather of Tesla bulls.
Mm-hmm.
Note out here.
I like that.
Reiterating his outperforming $500 plus price target, talking about how, despite the challenges from Musk and his Doge initiative and sort of the low polling there and then the lawsuits and the Tesla protests, these kinds of things are contained as a brand problem. And there's three big sort of catalysts that he sees as the big way to move Tesla stock in the back half of the year. The first thing is, of course, that cheap EV. We've been hearing about that. It's supposed to come, potentially back half of this year, second half of this year. I've said that it'll be on the roads prior to July, is what he says, and it'll help grow global deliveries. Second, also the new Model Y is out. That's the refreshed Model Y, their most popular vehicle. He says that will unlock new demand for that vehicle because it's sort of kind of hit its sort of, the last, I guess you would say, the last sort of emissions there for that car because it's just sort of long in the tooth. And finally, paid unsupervised robotaxi testing coming in Austin in July. That's the big one. That's the big $1 trillion opportunity. It's autonomous driving, it's robotaxis, things like that. He thinks that's the big step. Plus, with Musk being in the Trump administration, going to ease some regulations there from that point of view.
You bring up an interesting point about the Model Y refresh because, you cover automakers. Most automakers refresh their cars every single year. And Tesla does refresh the software that goes into Teslas, but in terms of the actual look, the comfort, the bells and whistles inside the car, they don't really change that stuff, right?
Usually every 2 or 3 years you get a facelift, which it has not had since it came out in 2019, 2020. So it's been 4 or 5 years. So it is time for this kind of update. You're absolutely right. I wanted to say the car's running on fumes. That's what I wanted to say earlier.
There we go.
So anyway, yes, that is a big deal for them, is to get that car updated and to more new users' hands.
What did you make, Praz, of this Bloomberg report we saw today where they say that Tesla is running this software update for China customers? It sounded like basically driver assistance capabilities that would be like the full self-driving we got here.
Yeah, autopilot, FSD, things like that. Tesla had said that they were anticipating an early 2025, spring 2025 release of that software, but they're behind the ball here with other competitors that like BYD and others that already have that stuff, that kinds of capabilities in their cars right now. Tesla had some regulatory issues to deal with the Chinese government. Seems like they've gotten past that now, and they're ready to deploy that software per the Bloomberg report.
Ross, thanks a lot. I appreciate it. We're going to stick with cars now. Bank of America downgrading Rivian from neutral to underperform, citing risks piling up for the company despite making progress towards sustainably positive gross margins. Here to discuss, Bank of America senior automotive equity analyst John Murphy. John, thanks for being with us. So this downgrade following the company's most recent report here, what do you think was most significant that we learned that led then to your downgrade?
Well, great. Thanks for having me. There are a few factors. First, there was lower volume than we were expecting in 2025 in their outlook. So about 48,000 units, sort of at the midpoint of the guide, and that's where we're landing. Lower profits off the back of that. But I think the third thing, which is really important, is the commitment to gross margin positive or moderately positive, as they mentioned in their outlook, includes a fair amount, a couple $100 million of profit coming from VW as a sort of a capital infusion that's running through the revenue line and through the P&L that really, I think, obfuscates the quality of the earnings in 2025. So that was a real kind of sort of boogeyman, I think, in some of the details. In addition to that, it sounds like the R2 is going to be a little bit lower volume and a little bit later in the launch than we're expecting in 26. And I think there's some questions that are starting to emerge with this DOE loan, $6.6 billion that the Biden administration finalized at the last minute. And there's some risk that that could potentially get canceled under the Trump administration and certainly under some of the actions of Doge right now.
What about that partnership, John, with Volkswagen? Because you also brought that up as possibly complicating earnings forecasts.
So the way the accounting there is working is a little bit different than you traditionally would in a JV. They're a minority partner, but they're consolidating the results. So that complicates the numbers quite a bit. But as I mentioned before, some of the capital inflow, about $2 billion, I think over the next 3 to 4 years, is coming in through the P&L, which is a little bit of an untraditional way for counting capital infusion. Usually that's coming through the cash flow statement in the financing section, not through the P&L.
John, I'm curious what would change your mind here on Rivian, right? I mean, I know you just downgraded the thing, but, do we need to see more of a turnaround, a wholesale turnaround in the EV market in the U.S. that could potentially benefit a company like Rivian?
So I think RJ and the team are doing a really good job on the product side. R1 really is an amazing product. If you've driven it, we've test driven it many times. It really is a really fantastic product, but it's an expensive one. So what we're looking at is a gap in product introductions until we get into 2026 with the R2, which is about a $45,000 plus or minus vehicle when it's launched. And that's where the market starts to open. Think about that as kind of their Model Y moment where Tesla really took off and volumes really started skyrocketing. So I think what we're going to need to do is fight through this next year and a half or so, maybe even more, till we get to that sort of more mass market product and things could really start clicking for the company. Really good product, great founder, really smart guy, understands what's going on. But execution so far on model launches has been so-so, and we really need to get to that higher volume product.
John, I'm just looking at the stock. It's up about 12% over the last 12 months. How does valuation look to you, John? Obviously, you don't think it's too attractive here.
Yeah, well, I mean, art is the beauty is in the art of the beholder here, because you're looking at something that's going to have a payoff pitch 4 or 5 years down the line when they turn free cash flow positive. So, we're looking at EV to sales right now to kind of benchmark companies that are in these early stages of ramping up. We're using 2 times EV to sales to get to our $10 price objective. In reality, you always want to look at a DCF, but without a lot of cash flow in the next few years, there's a lot of risk and uncertainty in looking at a DCF. So for us, I mean, we're looking at a $10, fair value at the moment. And we're going to have to see how the next few months or next few quarters, I should say, really develop over time.
And John, finally, I do want to ask you about Tesla. We were just talking about another analyst call on the company, an analyst who has been a bull, who is still a bull. There's been a lot of noise, obviously, around Tesla lately, but it's not just noise. The sales have been falling. We've seen some protests kind of bubble up around the country. Is that going to continue to pressure the sales, do you think?
Well, I think there's a lot of things fundamentally that are pressuring the company at the moment. Clearly, it's a first mover. They have great tech. They have a founder that's committed to the business. Love him or hate him, he really is driving that business hard. So I think there are a lot of things to like here. But I think as I heard in the prelude, the product is long in the tooth. And the Juniper or the Model Y Juniper is a mid-cycle major. We do a lot of study on product pipeline and our car wars analysis that we put out once a year and actually update periodically. They are really behind the ball on product intros. And kind of like I was just saying about Rivian, they really need to get on their horse and get a lot of new product launched. They're going to launch, supposedly, a low-cost product by the middle of this year, a second product off of that. That'll be sort of 3 and Y, lower-cost derivatives. And we have to watch their product cadence over time because no matter whether you believe this is a tech company or an auto company, product cycles always matter. They matter for the iPhone, they matter for cars, they matter for any other consumer good. And that's something they really have been behind on. So I think that is a real risk. And then you could sort of get into the questions on Elon's political involvement around the world and what kind of impact that's going to have on sales. The reality is that seems like a bit of a risk, to be honest, but something that is sort of secondary to sort of the core company being a little bit behind in product introductions.
More generally, John, just as an analyst who thinks a lot about this space, when you look at EV demand, over the next 6 months, 12 months, broadly, John, what does it look like?
Well, we have one major question mark. It's the IRA EV incentive of $7,500 for the consumer, and whether that persists or does not persist under the Trump administration. If that gets canceled, I think here in the U.S., we're probably going to be stuck at a penetration rate that's right around 8% where we were last year, and it may actually even fall from there. If the $7,500 sticks around, I think we'll see a drift higher, but clearly the consumer is pushing back. Most EVs are higher priced. For most folks, they're difficult to use because they don't have a charging station at home. So there is going to be some real challenges sort of from a fundamental standpoint. And if that IRA incentive gets canceled, potentially in the reconciliation process for the budget that the current administration is trying to push through Congress, there's some real risk that we get stuck at around 8%, give or take, in the U.S. for years to come.
John, great to have you on the show today. Thanks so much for your time. Appreciate it.
Thank you.
While we are wrapping up today's market domination, don't go anywhere. We've got you covered with all the action. Following the closing bell, stay tuned for Market Domination Overtime.
That's the closing bell on Wall Street, and now it's Market Domination Overtime. Jared Blicker going to be along to give us the details on today's session. I'm going to start with where we ended the day, which is with a little bit of a leg down here. The Dow still managed to close in the green, very barely, up by just 34 points. But you can see kind of the downward slope that we had in the last few moments of trading. Similar situation for the S&P 500, took it into the red, down about 0.5% after starting the session close to the beginning of the session in the red, then coming back and then ending the day lower. But the Nasdaq really saw the bulk of the losses today, selling in large cap tech, taking down that index by 1.2%, but similar movement here at the end of the day, seeing that selling intensify in particular and extending the selling that we saw at the end of last week. Jared's got a closer look now at today's action. Hey, Jared.
Yes, Julie, I think it's important to note that we did have a pretty negative day on Friday, and although we're not seeing it in the Dow, that is the Dow closed positive, just barely positive, we do see some negative continuing not only in the S&P 500, the Nasdaq, but also the Russell 2000. I'm going to show you a 2-month chart, and I'm going to put on the 50-day moving average so you can see exactly how the S&P 500 has been kind of dancing around it. Now it just closed below it. That's an important reference point that traders are paying attention to. Not the end of the world, but we do want to note that. Here's the Russell 2000. That's the 50-day. I'm going to put on the 200-day, and you can see it just closed below the 200-day. It stopped almost right there on Friday. So these are two negative developments for the indices that I'm going to be tracking with Josh in about 30 minutes. Now I'm going to show you the 10-year T-note yield, and let's take those moving averages off. It actually hit the lowest point in months, so that is somewhat risk positive, although you can't look at these things in a vacuum. Dollar just marginally positive, really not seeing anything too big there. Well, let's get into the sector action and look at some heat maps. And to do that, we're going to go back to an intraday time frame. And healthcare stole the show today. That was up 0.8%, followed by financials and then real estate. Tech was the only underperformer, and we'll take a look at that in a second, but that was the most negative. That was down 1.42%, and part of that today was Nvidia. Nvidia was down 3%, Broadcom down almost 5%, Palantir, worst day in months, if not years, that was down 10%, and you can really see this when you look at China. China just a sea of red today. I'm going to dig into that with Josh as well in about 30 minutes. Alibaba, worst day in a few years, that was down 10%. Pinduoduo, covered that. JD.com down 7%. List goes on. I'll close with the Dow. Dow managed a green close, thanks in part to Disney, Nike, Travelers, and a few others. Guys?
Thank you, Jared. Stocks ending the day little change as investors await key data, including Nvidia earnings and inflation data. So today's trade, Julie, interesting. Obviously, we had the coming off Friday sell-off. We attempt to hang out in the green there, but as you noted, we then kind of slide into the close there. Yeah. I thought some of the big tech moves were interesting today. Nvidia earnings, obviously that's big. Everybody's watching that. Earnings on deck this week. Nvidia was down today's trade. Microsoft, we saw that name slip. We talked about that. An analyst saying that they dropped some AI data center leases. Apple did manage to finish in the green, it looks like. And there, of course, we know the headline, $500 billion they're going to spend and invest over the next 4 years here.
Right. It is possible that we're still seeing some tariff headline sensitivity in the markets. You know, President Trump meeting with Emmanuel Macron of France today, and during the press conference following that meeting, Trump said that Canada and Mexico tariffs are on time and are moving forward. And as we know, they had been postponed by 1 month to March 1st, which is around the corner, coming up this weekend. So that could be something that is perhaps at the back of market participants' minds right now.
And we'll see.
Yeah. All right, well, the euro briefly moving higher as conservatives in Germany win elections. However, European markets still weighing what comes next. Traders are eyeing attractive opportunities in the global arena. FedWatch Advisors founder and chief investment officer Ben Emmons joining us now to discuss. Ben, before we dive into Europe, I do want to start with what we're seeing here in the U.S. and the action that we saw during today's session and that little bit of a pullback at the end of the day, following on the pullback that we saw last week. The markets kind of overall have shrugged off a lot of the tariff headline risk. What do you think sort of breaks through? Is it March 1st if those tariffs do end up going into effect?
Yeah, I think the market is still banking on that it will ultimately all come together, because this is the way President Trump sort of manages this process, right? A lot of threats, but then it gets the parties at the table and there's a conclusion. It's just like we're seeing it playing out with the Ukraine situation, where this mineral deal gets signed ultimately after a lot of threats. This is sort of the similar style. So I think this is why you get this very choppy reaction in markets currently. We're sort of sideways on the S&P and we're sort of sideways on the 10-year, a little lower. It's nothing like a flight to safety, uncertainty environment. It's really about a waiting, I should say, watchful waiting, if you call it that way. Because we do get that important data in between of inflation and other type of data. I also think what was an interesting other news fact was that the administration is going after, for example, Mexico to try to force them to also raise their tariffs on China too. So it's not just U.S. raising tariffs on Mexico, but also Mexico raising tariffs on China. So it's all about the similar idea of like, we want to get to an outcome where ultimately we're getting a better global trade system. At least that's the hope. I think this is where markets are waiting for to get that confirmation.
Ben, I'm also very interested to get your take on what we saw in Germany and the elections there. It looks like, Ben, the centrists led by Friedrich Merz prevailed, though we also did see strong support for AfD. What does that tell us, Ben, about the German electorate? What do investors need to know?
I think there are two things to take away from that. One, there is a big swing to the right again in Germany, which is happening across the Eurozone over the last several years. You know, I'm myself from the Netherlands. You know, I've noted there too a huge swing to the right, and I think this is really a reflection of voters just being really uneasy with everything that was done during the pandemic and the aftermath. I think that plays in Europe just as much a role there as it plays here. But then it's the bigger picture about, and this was important news. So Merz's party, they're negotiating about this defense fund, right? It's about 200 billion. I think that got the market a bit turned on today, of that they really want to put that fund together and invest in defense. And in addition, you could tell from German small caps and from technology shares, they have outperformed US markets. I think really because of a focus more inward by a party like from Merz that wants to look for more investment in Germany, almost with the quote that he said himself, Merz, about we want to be, let's say, not dependent on the US. I thought it was telling because it just indicates that they want to avoid these tariffs. We also don't want to rely on the US. They want to drive the economy themselves. I think that's the takeaway from this election.
Well, and, you know, Germany coming out of where we'll see if it's coming out of a 2-year recession, right? That's what he would hope to reverse. As a potential investor into Germany, is this an encouraging result from an economic perspective that, you know, the Conservative Party may have taken this leadership position, but that AfD did not get even more of the votes?
Yeah, and it's true, Julie, because in the European tradition, it does set up for a coalition that could be somewhat fragile, right? And that's the way the process works. They have to form a coalition. It may take another month or 2 months, maybe, of negotiating. So as much as Merz's party has had a big victory, it's not a completely, you know, let's say, certain political environment in Germany, unlike our environment here in the US. It's very clear what we're doing, right? And so, but investors, I think, are looking at this as a potential change of indeed, as you're saying, we're trying to get out of the slump, out of the malaise, the recession in Germany, by being more inward focused on investment and defense spending. I think that's enough for investors to be confident that no matter what coalition prevails, which will happen, you know, the spending will ultimately happen too. Germany is a conservative country, is really in line with Eurozone debt rules, so it has some room to spend. So I think that matters too for investors, that there's a capacity here to spend, so therefore prop up the economy. Therefore, the DAX will continue to outperform like the S&P for a period of time.
Ben, let's just talk about quickly here the German economy, because I saw a statement here. Christian Klein, CEO of SAP, of course, he was cited as saying Germany needs a government that is open to more innovation, a competitive mindset, and removing excessive regulation that stifles progress and growth, and it needs it now. Is Mr. Klein correct in your opinion, Ben?
I think he is, but it's something, what he's saying is something that's been happening for the last 20 years or longer. You know, we just, in Europe, never have made any kind of progress on that front in terms of regulation and improvement of productivity. So the Draghi report is, you know, as he's written about like what Europe should be doing about productivity, is a really important signal to Eurozone leaders. I think that's why you see comments like this come out. People have realized that, you know, they've really fallen behind too far, you know, to the US, to the UK, to elsewhere. And yet the Eurozone has a lot of resources and has a lot of technology and ability to do it. So I think this is an upside opportunity here. And for years, we've seen Europe trading at a major discount to US markets. And I'm not saying that completely will reverse, but there's some opportunity here that at least for these initiatives, they come through, which in the European way is significant because it takes always a little bit longer than in the US. Then I think the valuation will reflect that. You'll see some improvement of equity valuations as a result of anticipating that productivity and investment picks up in Europe.
Ben, thank you. Good to see you.
Good to see you, Julie. Thank you.
Fourth quarter results for Hims and Hers hitting the wire. So let's take a look at the numbers there. The share's actually down a quick 14%, which is interesting because the numbers seem to be pretty good here. Fourth quarter earnings per share, 11 cents. That is an increase over 1 cent year over year. Not clear what the comparable number is there, comparable estimate. But revenue coming out ahead of estimates at $481.1 million versus the $471 million that the company had been anticipating its 2024 revenue overall rose by 69%, and the company's forecast for the full year this year is higher than estimates, $2.3 to $2.4 billion. Analysts have been looking for about $2.1 billion here. So unclear exactly what is going on and why the shares are down.
Stock was a rocket ship. We should know that. It was up about 400% over the past 12 months heading into this print. I'm looking at comments from CFO Yemi Akupe talking about how revenue excluding our GLP-1 offering, he says, increased 43% year over year to over $1.2 billion in 2024. He talks about consolidated revenue increased 69% year over year to nearly $1.5 billion. As he says, our weight loss offering continues to offer an accelerant to these trends. So he is sounding a very confident, optimistic tone, but you're right, I mean, we're down here about 15%.
Well, the big overhang and the big question for this company going forward is whether they're going to be able to keep selling those compounded versions of the very popular weight loss medications that have been juicing their sales. And we're going to talk to him in just a little bit, the CFO.
You're going to get very quick insight on that very topic.
Exactly.
Coming up, we are getting you caught up on a few other tickers that are moving following earnings. Stick around, more market domination overtime. It's coming up. Stocks ending the day little change as investors wait on key data, including, of course, Nvidia earnings and inflation data. And joining us now is Ken Mahoney, Mahoney Asset Management CEO. Ken, it's good to see you. So, after that Friday sell-off, we attempt to come back there, Ken, but then we sort of slide there into the close. Ken, I'm curious what you make of today's trade, the action you saw, Ken, and what do you see ahead?
Yeah, I don't think anybody would like it. If you're long, if you're short, that's a different story, which most people are not. Look, on Friday, I thought it was a perfect storm, like everything hitting once. Some of the chaos in Washington, D.C. and slashing jobs and how's that going to show up investor sentiment? Well, we got that number as well. Walmart saying that tariffs are going to be something towards the second half of the year. Investors not liking that either. And, we had the OEX expiration to really kind of shake things up on Friday. Funny thing is, I thought it was somewhat constructive this morning or late morning when the market did go through Friday's lows, took out a lot of stop loss orders, looked like, and then rebounded. I'm like, oh, that's pretty good. And then we had this awful ending to the day. So, for bulls like we are, again, we expect escalators and elevators, escalators going up and looking pretty good. And then when it hits, hits like the elevator ride Thursday, Friday, and so far today, we can get a turnaround Tuesday. I think this is too far too soon. I'm still counting as bullish, but I hope for a turnaround Tuesday after we saw this kind of close at the low today.
Ken, we've been talking to a lot of investors recently who are diversifying, right? They're saying large cap tech is not the only game in town anymore. We got to look beyond that. I think, though, you guys are still looking at that large cap tech, or are you looking for it to fall even more before you want to get back in?
Right. So I think this is going to be a good year for tactical, putting some bids below, like where Microsoft's trading is one of our favorite ideas right now, coming off earnings down 40 points. And I thought their guidance was pretty good. I mean, you get all the verticals when it comes to Microsoft on top of it. Nvidia obviously is going to be the game changer, hopefully Wednesday. So look, we're growth managers. We do have some JP Morgan, that's not a growth stock. We know less regulations, administration is going to benefit companies like that. But we are going to stick with the big tech companies. We still think this cycle of spend. We came in this year thinking 20% year over year for CapEx and data centers and all that stuff. It looks like 25, 30% when we got through the earnings, with Microsoft saying 90 billion they're going to spend and Amazon saying 105 billion. It's kind of like they're all reaching out there. So look, we're going to follow the money. We know this is like a Bronco. We know there's more volatility in the space, Julie. But at the same token, there's no other industry that's seeing hundreds of billions of dollars being spent in infrastructure.
I was interested, Ken, to get your take on these recent comments we got from billionaire Steve Cohen. Mr. Cohen speaks, people tend to pay attention and for good reason. And it was interesting, Ken, because it sounded bearish. I mean, the way he was talking, it was slowing growth and sticky inflation and the possibility of retaliatory tariffs. I mean, it sounded negative. And I'm just curious what you made of some of these kind of negative arguments you heard there.
Yeah, I mean, Cohen obviously has had a great track record, so you can't dismiss anything that he said. Over the weekend, you heard from Warren Buffett raising more cash, and then you start looking around like, what am I missing? What am I missing? Look, I think, this year, unlike last year, I think the biggest drawdown last year was minus 6%. Our newsletter to investors in January, right from the beginning, said, listen, we're getting a lot more volatility than the 6% drawdown. Get ready for it. But I think in the end, it's going to be worth it. And if you're tactical and you're buying on some of these dips like we're seeing right now, and you could sell, a portion into rallies, and we'll have our rallies, but it's not going to be an easy kind of index, kind of let's hang out, make 20% in the S&P 500 this year. We noted to investors, it's going to be a little bit dicey with the new administration or 2.0 Trump, however you want to call it. It's not going to be easy, and you're going to have to get a lot more tactical to make your returns.
Ken, we got Nvidia earnings this week. Do you guys own Nvidia? What's your positioning around that one?
Yeah, so we've been Nvidia owners since, I'd say, summer of 2023. It's a long time, nice cost basis, have a nice cushion. Stocks trading at 131 just a few days ago, 141. We like this setup, to tell you the truth. We're coming in limping. I mean, I've seen other stocks, growth stocks like Nvidia, and the stock is ripping into earnings, and it sets a stage for sell the news. I think this is the opposite. I mean, really, this has been a lot of negativity. Concern about spend, concern about cycles, concern about Hellman, concern about, what Taiwan Semiconductor is producing, checking supply channels. But I think in the end, we're going to get a fantastic number. Remember, the CEO, they're not trying to get, a little bit more market share. They're trying to create new markets. And when I think about what they're doing here, I think, again, coming in to limping this, Wednesday, unless we get some rally tomorrow or Wednesday, is a pretty good setup for going long Nvidia.
Ken, we did get more tariff headlines today, and so I'm just curious, as a market pro, as somebody who has to actually put money to work, how do you navigate that dynamic?
It's difficult. I mean, the volatility is not really showing up in the VIX, so to speak. It showed up a little bit when it's trading at 14, 15, and now here it is at around 20. Yeah, I mean, like I said, let's say a Bronco. The reason I say a Bronco wants to knock you off, it's not supposed to be easy. And there are periods of time, like after the election, with kind of the honeymoon for Trump, it looked kind of easy. But we're right back to where it is, mostly for investors, mostly for the markets. It's not easy. It's not easy holding on with tariff talk and so forth. But if you're dollar cost averaging in, and you're averaging in here on some of the best names in each industry, I think it will be rewarded when we get some of this pressure off tariffs.
Ken, thank you. Good to see you.
Thank you. Good to see you.
Let's check out on some tickers that are moving after hours. Shares of Diamondback Energy higher following that company's fourth quarter earnings that beat the average analyst estimate. The company's earnings per share coming in at $3.64, well above expectations of $3.34.
And taking a look at shares of Zoom Communications, they are sliding after the hours here. The company reporting earnings moments ago, but it's guidance that's spooking investors. Zoom's 2026 full-year revenue guidance just missing analyst expectations. Zoom seeing annual sales between $4.79 and $4.8 billion. The estimate was for $4.81 billion. For the fourth quarter, adjusted earnings beating estimates and revenue came in line.
And Chegg in focus, shares there sliding after forecast subscription services revenue for the first quarter came in below expectations. The company topping fourth quarter earnings, but the guidance has the stock under pressure. Total net revenue expectations for the first quarter coming in between $114 million and $116 million. The street was looking for more than $138 million. That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Ask You for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories, including a conversation with the CFO of Hims & Hers Health. It's following the company's latest earnings results. Stay tuned. Hello and welcome to Asking for a Trend. I'm Josh Lipton, and shares of Hims and Hers Health, they are dropping despite a beat on the top line and a better than expected outlook for the first quarter. Here to discuss is Hims and Hers Chief Financial Officer, Yemi Okupe. Yemi, it is always good to see you. So you did just report results. Initially, it does look like investors are disappointed here in the after hours. Yemi, but walk us through the results, the quarter, what's driving the business?
Yeah, thanks for having me. We're seeing our model, which centers on providing access to personalized products and delighting subscribers through exceptional service, really resonating incredibly well with consumers. This is translating into very robust business performance. So in 2024, we ended the year with over 2 million subscribers on the platform, of which 1 million or over 1 million were opting for personalized solutions. We saw EBITDA margins more than double year over year to 12%. While also growing revenue 70% year over year to $1.5 billion.
Yeah, I think what everybody wants to know is what's going to happen with compounded GLP-1s, right? As we now know, the FDA has said that the shortages are over. That means, at least in theory, that you all will not be able to sell compounded versions anymore. There had been some question of whether there would be some sort of legal dispute about this. Where are you guys in that whole process? And if you can't sell them anymore, what's that going to mean to the results this year?
Yeah, I think that there's a lot of excitement around weight loss, and understandably so, just given the obesity epidemic across the country. Our aim at Hims and Hers is to build a robust platform that's able to treat multiple specialties. And our aim is not to necessarily just be a weight loss company. That said, we do view having an evolving weight loss specialty as an important component of helping fulfill our mission of helping the world feel great through the power of better health. But we view it as an additive to what's an already very strong and robust non-GLP-1 business. So to contextualize our 2024 results, of the $1.5 billion of revenue that we delivered, $1.2 billion of that came from non-GLP-1 related sources. Also, prior to launching GLP-1s, we achieved positive net income as well as positive adjusted EBITDA. And so while we're excited to have 200,000 subscribers join our weight loss specialty over the course of the last year, it's also important not to lose sight of the other 2 million subscribers that have signed up for non-weight related businesses.
All of that understood. I don't think I got an answer to my question there, Yemi, as to what you guys are doing with the compounded versions of GLP-1s, whether you'll continue to sell them, and what kind of sales numbers you expect from those products this year.
Yeah, it's a great question. So our objective is not to disrupt or circumvent any type of regulatory standard or bodies that have kept consumers safe for decades. So we do fully intend to abide by all regulatory requirements, and when necessary to do so, we'll remove all commercially available dosages of semaglutide from the platform. That said, we are confident that even in the absence of commercially available dosages of semaglutide, we still have a very robust weight loss offering. Our oral-based weight loss solution that launched in 2023 was able to scale to over $100 million run rate business within 7 months and is now offered for as low as $69 per month. We're excited to bring liraglutide to the platform later this year. And also, we do expect to, where it's clinically necessary, offer personalized dosages of semaglutide. And so all of those products come with the benefit of high-frequency access providers, access to our tools, and other benefits on the platform. And so we're confident that even in the absence of commercially available dosages of semaglutide, the weight loss offering will be very robust.
And just to put a fine point that on, Yemi, I do see a headline drop in here that you all will pull commercial doses of copycat Ozempic. Is that accurate?
Yeah, so when we are required to do so, so embedded in our guidance is after the first quarter, assumed in our guidance is no revenue from commercially available dosages of semaglutide.
So when you guys come out with this revenue forecast for this year, it's above analyst estimates, $2.3 billion to $2.4 billion. How much of that assumes these products? And sort of, I guess, talk me through the cadence then of revenue growth through the year. Is it going to be front loaded because you at some point you're going to have to pull those doses, as you said?
Yeah, so I think we're expecting a strong revenue growth trajectory throughout the year, just because the other elements of our weight loss specialty, as well as our tenured businesses that still compose of the majority of our revenue, are expected to continue to grow. And so when we look at the value that we're bringing to subscribers across both our weight and non-weight specialties, things like exceptional service through the provider engagement, the ability to personalize medications, which will be further augmented by some of our recent capabilities, such as the lab that we recently acquired, we're confident in the overall trajectory of revenue across the year.
You know, your company's core specialties, Yemi, I think people think of, hair loss, behavioral health. What are the next big categories on your radar? What are the next potential unicorn categories?
Yes, I think we are setting the foundation for continued personalization across even our tenured categories. So we're seeing continued robust growth through offering consumers new avenues of value through our existing specialties. So we do expect those to continue to grow. As we've acquired capabilities such as diagnostic lab testing, that personalization we expect to get deeper and deeper in the coming years. Our lab testing capability also sets the foundation to enter other specialties that we've spoken around previously, such as menopausal support and low testosterone. So we do expect continued growth of our core specialties, which is inclusive of weight, as well as the ability in the coming years to leverage the capabilities that we've acquired to enter other specialties as well.
One of the other acquisitions you guys have made also has to do with home blood testing. So talk to me about how that is going to integrate into the business and what that will do for you.
Yeah, and so when we step back and we look at what is the vision for Hims and Hers, we view ourselves as paving the way for the next generation of healthcare. Historically, we've been able to provide consumers with the benefit of things like transparency into pricing, treatment recommendations, as well as convenience. Over time, we've rolled out our personalized solutions. When you think around one of the elements that is very powerful across Hims and Hers, it's our closed loop data system. The ability to walk with consumers along their journey and identify what are the elements of treatment that work for them. Having diagnostic lab capabilities provides us the ability to make those treatments even more precise through being able to identify things such as vitamin deficiencies, as well as unoptimized health indicators, which we view will enable us to, when paired with our affiliated pharmacies, offer a greater degree of precision to our subscribers. Additionally, the lab diagnostic capabilities can serve as the foundation for entry into new specialties, such as menopausal support and low testosterone.
Right, and those are definitely growth areas, to be sure. Yemi, finally, I do want to circle back around to GLPs for just one more question. And this has to do with the Super Bowl commercial that you guys came out with. You caught a whole lot of heat for different aspects of this commercial. It seemed like it was pretty controversial. And it's for a product that you guys aren't going to be selling in a little while. So I'm curious if you feel that was the right decision, if it got the company the right kind of attention.
Our aim was to start a discussion. And so we are transforming the way that consumers receive care. And it's not lost on us that is uncomfortable and scary to incumbents. But to say, as Big Pharma is doing, that all compounding is unsafe or legitimate, is simplistic at best, or one can argue as a disingenuous way to stoke fear across hundreds of thousands of Americans whose clinical needs fall outside of what's commercially available. Our aim is not, again, to look to circumvent any type of regulation or identify a loophole, but we are committed to ensuring that consumers that have a clinical need beyond what is commercially available do have the ability to receive treatment.
Yemi, appreciate your time today. Thanks so much for running us through the quarter and the outlook.
Thanks, guys.
Time now for What to Watch Tuesday. That's February 25th. Starting off on the earnings front, we're going to be getting a big batch of results throughout the day, including Home Depot, Keurig Dr. Pepper, and Intuit. Home Depot announcing fourth quarter results before the opening bell. Analysts expecting the company's same-store sales to fall by low single digits.
Apple is hosting its 2025 annual shareholders meeting in the morning. Investors will get a chance to vote on a wide variety of issues, including diversity initiatives. That's something the company has come under fire for from its shareholders.
And Supermicro Computer approaching an important deadline tomorrow. Company is set to report its delayed earnings results. Supermicro facing a possible delisting from the Nasdaq if it fails to file that report.
Moving over to the Fed, some more commentary coming tomorrow, including Fed Presidents Lori Logan and Tom Barkin. They're speaking after comments last week from Atlanta Fed President Raphael Bostic. He told Yahoo Finance he's not taking anything off the table when it comes to interest rate cuts at the next Fed meeting.
And taking a look at the economy, we're going to be getting the monthly consumer confidence reading for February in the morning. Economists forecasting confidence to dip compared to January to 102.7. This coming after last week's consumer sentiment reading, where we saw long-term inflation expectations surge. Stick around, more Ask You for a Trend on the other side. U.S. stocks closing mixed with the Nasdaq and the S&P 500 sliding as tech lags. Yahoo Finance's Jared Blickery joins us now with the trading day takeaways. Jared.
Josh, I will remind everyone that the second half of February kind of has some bearish seasonality. Right now, in reality, we are seeing a slow motion breakdown. Nothing to worry too much about, nothing to write home about, but there are some warning signs. This is a 6-month candlestick chart of the S&P 500. I'm using candlesticks because it's going to show the close of the day and the relationship to the 50-day moving average. We just got to close below that. So that's a significant reference point in the market. I'll zoom in. This is a 2-month chart. Also want to show what's happening with the Nasdaq. That is well below its 50-day. It closed below that on Friday. And finally, here's the Russell 2000. This is going to show you the 200-day moving average. It closed below that just a little bit Friday, and now it is down below. So we are just kind of incrementally breaking down. And so that was my little warning there. Now, this potentially let me just show this chart right there. We go. So potentially this has a potential to reverse in the month of March, and we could be on our way to new highs. But so far, we have seen this kind of reflected in the returns that we've seen so far in February.
And of course, February nearly over, nearly in the rearview mirror. What are we seeing there? How's the Mag 7 been doing?
All right, let's take a look at the Mag 7 because we got some Mag 7 madness. I'm going to show you a heat map of the performance of the mega caps since the beginning of the year, and there's going to be one stock in there. There we go. All right, these are the mega caps. If you're going to look at this, Meta is up 14%. We've seen a number of these issues drop below the unchanged line. Look at that, Berkshire Hathaway up 10%, but Tesla down 18%. Apple, though, has been doing well. Over the last month, it has bounced off its 20-day or 200-day moving average. It is up about 11% right now. So that is a positive. But meanwhile, Amazon is down 6 days. Meta is down 5 days. Remember that we had that 20-day winning streak, and that was pretty recently. Here's a year-to-date chart. Well, that is now 5 days to the downside. So kind of a reversal of fortunes that we're seeing here. Now, I want to get to Nvidia. Everybody's awaiting those earnings. Just had an interesting conversation with Lee Munson over at Portfolio Wealth Advisors on stocks in translation. This is what he had to say about the AI trade in general, not necessarily Nvidia, but take a listen.
Look at big enterprise places like a Salesforce, like an SAP. Look at places that are going to easily say, we thought it was going to be late 2026, but guess what? By the end of 2025, we're going to be able to provide your enterprise a bolt-on AI doohickey, as we'd say, that's going to make a railroad company have logistics on a way that we can't even imagine. You know, it's the same thing and we're going to see a renaissance in industrial America where it's, if you're building things or making things, you have to get something from here to there. Whether you're a large-scale home builder or you make aluminum cans, AI is going to be able to help streamline that and increase productivity because GDP equals hours worked times productivity.
So maybe the big trade isn't necessarily with Nvidia. We just need to wait a little bit and see what kind of productivity enhancements it brings. And that's not necessarily the near future, but kind of a year-long story. And we definitely have to watch productivity there.
Berkshire Hathaway, by the way, you mentioned that.
Over the weekend.
Not a Mag 7, but close.
Let's just look at this chart here because Berkshire is kind of the sleeper. It's maybe the Mag 8 there. Well, guess what? That's a record high. $747,000, 486 per share. So the number is big and impressive. All right, we got to get to our third one. And I have been tracking the international wave. We've seen a lot of outperformance in the DAX from China, but we got BABA earnings overnight. So that's why I'm saying BABA buy. But I don't think it's the end of the world for BABA. This is a 10% decline, worst in a few months. Let's take a look at China if we can find that. There we go. This is going to be a 1 month. So let's get the year to date. And you can see the incredible outperformance here. Even after the 10% decline, BABA's still up 52%. Lots of green here. But a lot of people are going to be asking themselves after this latest miss, is this buy the dip or do I wait?
I was going to say, gee, I'm a trader. I'm waiting. Buying opportunity. Frustrating top.
Yes, frustrated top. I like that. Here's a 5-year. Well, you can see in the 5-year context, we are still in the early innings of anything approaching a recovery to those pre-pandemic highs or the early pandemic highs. So this stock has a long ways to go. I don't know if it recovers immediately, but I would be surprised if China doesn't kind of pull a rabbit out of the hat and make some additional gains this year. I don't think the China rally is over, but it is notoriously difficult to predict.
Berkshire to BABA. We covered it all.
You got it.
Thank you, my friend. Well, the NFL, MLB, NCAA, and NASCAR have thrown their support behind a bipartisan bill that gives local law enforcement the authority to disable drones above large sporting events. Current law empowers federal authorities to disable drones for certain major events, but that ability does not extend to local and state authorities. Well, joining me now is Matt Higgins, RSE Ventures CEO and co-founder and PDW co-founder. Matt, is great to see you. So listen, you're very, I know, Matt, you're involved in all things drone. You think about where this industry is and where it's headed. There are those recent headlines, Matt, I do want to start there, that are interesting. You have these major sports leagues, whether it's the NFL, the MLB, that are apparently supporting this bill, Matt, that I guess would limit the use of unauthorized drones over sports stadiums. What do you make of that, Matt?
Yeah, I mean, this shouldn't be controversial, by the way. I think most Americans presume this is already happening. So let me lay it out. Simply put, already there's a perimeter around major stadiums where you can't fly a drone. That makes a ton of sense for a variety of reasons. But the problem this legislation is addressing is unless there are federal law enforcement officials on site, nobody can do anything about it. So if you spot a drone and your local law enforcement, you can notify your colleagues, you could attempt to track it down, figure out where the operator is, but you can't actually interdict and use these tools that are out there. So this legislation takes an obvious step and basically gives permission to a local law enforcement to operate an interdiction scenario, whatever that is.
I guess my question would be then, does local law enforcement, do we know whether they have actually the technology and the tools, Matt, to go ahead and disable an unauthorized drone?
Yeah, I mean, that is the big question. So going back in my career, I helped oversee the rebuilding of the World Trade Center site. So I stood underneath those towers soon after the attacks, and I said, how does this happen here? And honestly, once I started interacting with drones around 2015, I said, my God, this is going to happen again, except the next time it won't be planes, it'll be drones. And so we are at the moment unflanked. We don't have a nationwide system to defend our venues, our buildings, our cities from an incoming terrorist drone attack. So passing this legislation is just one obvious step, and I want to commend Senator Cotton and Secretary Hegseth for pushing it forward. But what we actually need now is for an entire government to rally together and begin to not only implement, but develop the tactics we need to stop an incoming drone. What works in the military battlefield, maybe jam a signal, interdict a kinetic force, doesn't work in the middle of New York City. So we need a whole wide variety of solutions, and then we need to train local law enforcement about how to implement them.
Why don't we have that set up here and now, Matt? What are the reasons for that?
I mean, honestly, it wasn't prioritized in the previous administration. I give President Trump a ton of credit, and also Secretary of Defense, for saying this is one of our top 17 priorities. I think number 7 on the list was counter UAS. We just haven't been able to organize ourselves, and the threat is very real. And so the second reason is it's pretty complicated. It's not like there's a single solution. So I'll give you an example. There's a company called Fordham. It has basically a catch and carry. You see an incoming drone, you go after it. If it's unfriendly, you go ahead and use a net system, and then you deliver it to a designated spot. But that's just one solution. There will come a day where we have autonomous drones that are sending a swarm towards a target, and you're going to need an autonomous solution. So can you imagine how complicated that would be to train law enforcement in every city on these ever-evolving tools? I was recently in Poland, and I was meeting with troops and understanding what's going on, there, and the tactics are changing like every single day. So this really does need to be a national priority. This legislation is the first step.
Matt, always great to see you, to have you on the show. Thank you, sir.
Thank you.
Coming up, we're looking at a new note from UBS and why the firm is overweight on Europe. We're asking for a trend that's right on the other side.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Podcast that will make you a smarter investor.
Welcome to Stocks in Translation. I'm your host, Jared Blickery. Welcome to Financial Freestyle.
Hi, I'm Bob Powell, and welcome to Decoding Retirement. Welcome to Living Not So Fabulously.
Welcome to Trader Talk, the podcast that dishes out the market straight up.
Welcome to Capital Gains. I'm your host, Madison Mills.
Welcome to Word Money. I'm Patrick Murphy.
And I'm Dan Coons.
From Wall Street to Main Street to the C-Suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
For our chart of the day, we're looking at a new note from UBS and the reasons to be overweight on Europe. Yahoo Finance's Julie Hyman joins us now with a closer look. Julie.
Yeah, we've had sort of a drumbeat of investors talking about this. Andrew Garthwaite over at UBS is the latest to enumerate some of the different reasons, and valuation is the reason behind our chart of the day. So UBS looking at the gap in valuation between the MSCI sector-adjusted 12-month forward price-to-earnings ratio relative to the U.S. So this is the valuation gap between the two. You've got the average here, the dotted blue line, and then the standard deviation, the sort of normal range, is the green dotted line here. And as you can see down here, basically what we have is that we have not seen this kind of standard deviation, basically, or this kind of gap, I should say, going back to 2007. In other words, put another way, the sector-adjusted European stocks are trading at their lowest versus the United States going back to 2007. One of the many reasons that UBS enumerates as ones to get in on European stocks right now, they also talk about that there has been an improvement in relative earnings revisions in Europe, that has not been priced in, however, and so that should provide an upward catalyst. And speaking of catalysts here, we recently spoke to Christina Hooper. She's Chief Global Market Strategist at Invesco, and she also likes Europe right now. She told us why.
The United States is in a very good place, but you don't need a great economy for a stock market to perform well. What you need is positive surprise, some kind of catalyst. And what we likely have in terms of catalysts in both the UK and Europe is slightly improving growth picture and, of course, the potential for significant rate cuts this year, which we know we don't have in the U.S.
So Christina also giving some reasons to potentially buy in Europe. And the backdrop here in the U.S. is that valuations are relatively rich, according to many investors. Not so in Europe, Josh.
All right, thank you, Julie. Now let's take a look at what's trending after hours here. Shares of Riot rising as full-year net income topped Wall Street expectations. Company's Bitcoin mining revenue also beating estimates. Looking ahead at 2025, Riot highlights it's pursuing opportunities in the AI and high-performance computing sector. Moving over to Cleveland Cliffs, those shares are falling after hours. The company reporting results for the fourth quarter slightly missing on revenue estimates, coming in at $4.33 billion. The U.S. steel producer sees capital expenditures of about $700 million for the year. In 2025, steel unit cost reductions of about $40 per net ton compared to last year. And finally, shares of Trex company higher after reporting EBITDA for the fourth quarter, beating the average analyst estimate. The decking company posting net sales of $167.6 million for the quarter, which fell 14% year over year, but still exceeded expectations as the street was looking for $160 million. Let's wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a great night.